Hi there again, and welcome back to Unit 4. This is the second segment of this unit, talking about income statements and their analysis. Let's get to the content here and finish up this section. So, whenever we are analyzing net farm income, it's important to think about this first question here. A business can show profit for a year, but is it actually a profitable business? And I know that might sound like a weird question to ask, but for 1 year, a business could show a profit, but is it over the lifespan actually a profitable business? So, for example, two farms, same net farm income, may not be equally profitable. If one used twice the land, labor, and capital, their net farm income positions are probably different. So, profitability is a measure of efficiency of the business to use the resources that they've got available to produce that net farm income. So there's some key items that go into analyzing the net farm income position. So there's basically four measures of profitability that we will suggest that are important when analyzing this net farm income and the income statement that we've been talking about. Number one is net farm income, the number that we've done the calculations to actually come up with that raw number. Number two is the rate of return on assets. Number three, rate of return on equity. And number four, the operating profit margin ratio. Again, can kind of take size out of the picture, so to speak, and give us a number to kind of think about. So again, here's that chart of accounts. We come in, start with an example here, and I'll let you pause the video here to kind of study the numbers if you so choose, because we're going to use this as an example as we proceed through this second video segment here. Okay, first things first, just like we've been talking about, net farm income, amount by which hopefully revenue exceeds expenses plus any gain or loss of sale of assets. So basically, what do we have left to provide return to the operator for unpaid labor, management, and equity capital used? So this is kind of the starting point for analyzing the profitability of your business. Now, one thing to think about to start, I'd like to introduce as we start thinking about this concept all the way through, is oftentimes farm businesses especially, not really all agribusinesses, because certainly they're structured a little bit differently. But farm businesses generally look at whatever's left at the end of the year. That's what I pay my family for labor, so to speak. That's my labor cost, especially if it's a single family sole proprietorship business. And that's what I would suggest how we need to start to change how you approach this, is you should really think about how does you need to think about paying yourself for labor. Count that as an expense all the way through the farm business, so that you know what it truly costs you for labor, and you can put in a reasonable labor amount so that you have a better net farm income picture at the end of the year. The second metric here that we'll look at again is rate of return on assets, or your return on investment. So the return on investment is kind of the more commonly known term here, but it measures profitability with a ratio that divides dollars returned to assets by average farm asset value for the year. So hopefully you can utilize this for easy comparison between farms or multiple years on the same farm. So basically what this would do is indicate net farm income if there was no debt, you had 100% equity. But again, adjust if you're not counting for labor in there or management expense, you've got to subtract that out and adjust your net farm income to get an actual rate of return. So here's a good example to think about if you're investing in a new piece of equipment or a new parlor or something else different on the farm. This is a good number to begin running and seeing how is that going to save you time and or money, and especially money. So really, this is a great metric and one of my favorite ones in this particular slide set. So again, we get back to our example here. I've circled the two numbers that you would be using in order to calculate your return on investment here. And I'll let you pause the video and do that calculation. And we will be practicing this on our assessments in class. Same thing as we get to back to that balance sheet number here, and I've circled that total liabilities number. But again, you could pick out that rate of return number. Again, we'll be practicing this in class. We'll see some different ones here as examples. But calculating a return on investment, really critical. Now, we're going to convert that dollar figure to a percent. So from the balance sheet and the market basis value, we can start to figure out what your rate of return is as a percentage basis. So one of the things is, as we do this calculation, we're looking at adjusted return to assets of $51,300 and an average total asset value of $725, $750. Those are coming from this previous slide. So basically, we're looking at a rate of return of 7%. You say, well, why is that an important number? Well, you would want to compare that to an interest rate, because for an investment's sake, you could take that money and that you just invested in a piece of equipment or a new structure, and if you did this calculation and say, well, I could get 7% return on my money, what would happen if you took that same money and invested it in a different asset on the farm? Or what would happen if you could take that money and invest it in the stock market? Basically, what is your opportunity cost? And also, hopefully, that rate of return on investment is greater than the amount of interest that you would pay on the loan if you had to take out a loan to build such a structure or buy that piece of equipment. So it's a good comparison number to really look at and think about, where are we making money and where on these assets and where aren't we? So some things to remember. It's not recommended to use net farm income because it can skew the return on your asset. Opportunity costs for unpaid labor and management are estimates, and changing them clearly affects your return on assets. So make sure that those are accurate numbers. Compare return on assets only when they are calculated the same way. So if you're comparing year to year, make sure that you are calculating that the same way every single time. That way it's an oranges to oranges comparison. And the value of any personal or non-farm assets on the balance sheet should not be included on the return on asset number. Good notes to consider when analyzing some net farm income things. Next is your rate of return on equity. So again, we're going to begin with our net farm income from operations. No adjustment for interest expense. We're going to deduct opportunity costs, so basically your unpaid labor and management expense. So I've pulled some things off of that balance sheet that we've been showing you. And so basically we have a $21,800 return on equity, and we divide that by the average equity from the start and the end of the year, $358,565, and we're going to get a 6.8% return on equity. So we're going to use that again to compare that to our rate of interest to evaluate if the business is adding or subtracting equity and determine solvency of a business. Again, a good financial analyst's term or number to use as a good metric whenever you're sitting down and doing a review of a farm's profitability. Again, here's that chart of accounts again. Again, I'm not going to spend a lot of time going through this because it get really cumbersome in an online lecture format. So we'll move on. This is one of the final ratios that we will mention here on the net farm income and using an income statement, and that's operating profit margin ratio. So an operating profit as a percent of total revenue. So the higher the value, the more money the business is making per dollar of revenue. So you've got to find the absolute dollar value for operating profit. So how we do that, we take net farm income from operations, we add interest expense, we subtract opportunity cost for labor, we subtract opportunity costs for management. That gives us our operating profit. Eliminate debt expense, eliminating debt expense gives us the opportunity to compare farm to farm. Bottom line, using again that same chart of accounts that we've been talking about, if we pull out some of those numbers from this example here, we would suggest that for every dollar of revenue that we've brought in, 25 cents of that dollar remains as profit after paying all the expenses. So a 25.6% operating profit margin ratio. So you say, well, what does that mean again? So 25, you're going to, for every dollar that you made in revenue, 25 cents of that dollar is going to stay in your pocket as profit. So farms with low operating profit margin ratio should probably concentrate on improving that figure before expansion. And that's where folks tend to get kind of out of whack with how do you make more money? Getting bigger doesn't always mean you are more profitable and make more money. Being more streamlined, being more efficient, oftentimes affects this operating profit margin ratio versus just simply getting grossly bigger. So that's a key thing to think about as some of you maybe think about going back home to the home operation is how do you evaluate where you're at? And this is a great number to look at. Okay, as we kind of begin to start wrapping this up here, some questions to consider after we analyze net farm income. If we have profit, what was it used for? What did we do with it? Where did the money go? Did the profit affect the balance sheet and how? So now we go back to that balance sheet and look at it again. Did we add equity? Is our net worth increased or not? But bottom line is all net farm income ends up in one of four uses. Either you as the owner or operator withdraws those dollars for family living expense, or you take that money and you pay income and Social Security tax, or you have increases in cash and other farm assets, meaning you added to the savings account, or you went out and bought another asset, or you had a reduction in liabilities through principal payments on loans or payment of other liabilities. And what I mean by that specifically is not only did you make your payment that was stated to be made, but maybe you made an additional principal payment. So that money went somewhere to start to decrease your total liabilities. Net farm income is going to land in one or more of those four things. And so it's important to know which one of those did it go to and how much. And it's kind of a flow chart of where some of those things probably do go. And so it's great in terms of this is going to lead you to as you look at a change in owner equity position, if you look at your balance sheet and your net worth went up dramatically from one year to the other, you can go back to your cash flow statement or your income statement and know where that came from and maybe why. Again, here's another example. So owner equity starting on July 1, this is old information, for sure, but net farm income, some less adjustments for income tax. And so we get all the way to the bottom and we see an owner equity position on December 31, 2010 of $372,000. So, we gained almost $30,000 in equity position just in that year. So appears to be a pretty profitable year. So what remains in retained farm earnings? What's left after you make those personal withdrawals, pay your taxes, and retain for farm business? If positive, your equity is going to increase, your net worth increases, and that's what you're hoping for. If it's not, then clearly we have decisions to make and we have things to revisit on how do we get more profitable. Cash flows, flowing in and out of cash in a business during an accounting period, basically all those things are going to be organized in 5 categories, whether it's operating cash, investment cash, financing cash, non-farm cash, or simply cash on hand. So tracking where your cash goes is a great way to be able to forecast what that income statement is going to look like. Again, another chart of accounts look, and we continue to look at these types of things. We can look at cash in, cash out, and net cash flow here. I'll let you pause the slideshow here if you like and review this. Bottom line, that wraps up our Unit 4 on the income statement and its analytics. We're kind of in the segment of the course here and starting to reach the end of it where we do a lot of analytics of financial condition of agribusinesses or farm business. And it's important that you don't get too mucked up into um, the details here, because we'll continue to practice them in class. But each of these units tells you a different piece of the story about a farm business or an agricultural business's financial position. The balance sheet tells you one story. The depreciation schedule is utilized in different ways. The income statement tells you another piece of the story about a farm business's or agribusiness's financial picture. All of them come together in order to inform you, the manager, about how your operation is performing from a profitability standpoint. And we hope as you collect this information and begin to put it together in the pieces of the puzzle as we go through the course, you'll see how each of these tools can be used to help you become a more profitable business. Thanks for tuning into this section.